Another strong day in grains following Friday's really bullish report for corn and beans. This USDA report is usually a top 3 most important report of the entire year, regardless of the outcome. In Friday's report, we saw the largest November to January report yield drop in soybeans ever. It was also one of the largest drops in corn yield in recent memory as well. And all the production numbers for corn and beans fell well below the trade estimates. So yield fell below for both corn and beans, and the carryout also fell below. Now here's corn carryout. Corn carryout started the marketing year at over 2 billion bushels. It is now down to nearly 1.5, so this green line right here. Carryout has dropped in the past 7 straight reports. That is the longest streak in over 20 years. If we take a look at this chart from Susan at Noble Egg, so the yellow line right here, this is the current carryout. Right now we are right about on par with where we were in 2021 as well as 2022 at this same time period in the year. So 2021 is this blue line, 2022 is this green line, then yellow 2025. Looking at this chart from Karen Braun, corn yield has failed to break the USDA's initial trend line yield for the 6th year in a row. The market first called for 180 bushels per acre back in 2018. It is still yet to happen even with the near perfect summer for the I-states this year. The trend line might be too aggressive. Although we have had record yields the past 2 years, yield's been pretty much just chopping around this 170 to 175 range since all the way back in 2013. So now how does this change things? Let's take a look at the US versus world situations. So first we have corn. The stocks to use ratio is by far the most accurate way to determine how supply and demand is shaping up. So for corn, we are now near bull market territory. Usually that's considered to be under 10%. When the stocks to use ratio is under 10%. Right now we're at 10.19%. It's not quite as bullish as 2020, 21, 22, 23, where we did see 8 to 9%, but it's far friendlier than 2023, 24's near 12%, and far better than the bear market years from 2014 to 2019, where the stocks to use ratio ranged from 13 to 16%. So right now we're just kind of basically in the middle of these bear market years and the bull market years, just kind of right in the middle. Looking at the world situation, corn actually has its lowest stocks to use ratio since 2013, 2014, as it has continued to decline for the past 7 of 8 years. So the only year we didn't get a decline was right here in 2021-22. This is decently friendly as well. Now looking at soybeans, just like corn, we're kind of somewhat in the middle of a bear market and bull market based on the U.S. Balance sheet, but it isn't quite as close to the bull market as corn. But it is the most bearish we've seen since 2019-2020, as this is the highest stocks to use ratio we've seen for the past 5 years. Taking a look at the world situation, this is of course the biggest issue for beans. We are at the second most bearish of all time. Argentina could potentially still face some issues, but there's a decent chance that Brazil's monster crop is going to be more than enough to make up for the losses. So even if Argentina does have some issues, it's just not going to make this major dent in this figure on a global scale. Now if we take a look at US wheat, we are somewhat in a more bearish situation compared to the last few years, but nowhere near as bearish as years like 2017, 2018, where we're all the way up to 55% stocks to use ratio, now currently sitting right around 40%. Now, the world situation for wheat is friendly. This number has shrunk for the 5th year in a row. We're now sitting at our smallest number since 2014-15. And the global wheat situation is even more friendly when you use only the major global exporters. So you take out countries such as China, who grows wheat but doesn't actually export any. So right here, that would be this pink line. It just shows the world's top 8 exporters. This green line would be if you just took the world minus China, and then this gray line is the world. Taking a look at today's main takeaways, first for corn, the funds are now long 250,000 contracts, with some rumors that this number is now closer to 300,000 after the report. Corn was trading at nearly $7 the last time funds were this long corn. So if you come straight across right here, this would be February 2023. Now short term, I think this is friendly as they're wanting to buy corn for a reason. They don't just go from holding a record short to now holding the largest long position they've had in 2 years, all in the span of a few months, for no rhyme or reason. They're long for a reason and like to follow the trend. More often than not, the funds tend to be right, just like how they pushed corn to multi-year lows with that record short. However, taking a little longer term view of this, we do have to be cautious of them selling here. As in other bear market years, they usually do top out right around this area, 200 to 280,000 contracts. And then in bull market years, usually that number is closer to 400,000. But for now, it does look like the funds are on board. Now, another big issue corn might face later this year is going to be acres. One of the reasons why the spreads have rallied so hard, meaning old crops strong versus new crop, is because the market's very aware of this potential acre issue. There's several people calling for 95 million acres of corn this year, so this has been weighing down new crop corn. So right here, this is the soybean to corn ratio chart. We currently still heavily favor more corn versus bean acres. So this line above it favors beans, below it favors corn. This is the smallest this ratio has been for this date since 2013. But with that being said, I do think corn still has potential here. We have shifted the fundamentals completely, going from a 2 billion bushel carryout to now nearly 1.5. I'd like to think that these 25 corn has a real chance to eventually trade in the realm of $4.75 to even $5 at some point. If we look at this chart, our next targets for these 25 are going to be 624 to 472, so our 50 to 61.8% retracements of these May highs. Now, I don't love making new crop sales here unless you have your inputs locked in, but it's not the worst idea to start scaling into a small amount of sales at 464 and then 472, then 484 and so on. A simple idea would to just be to sell 5 to 10% at each fib level along the way up. Now, no, we have not officially alerted a sell signal for new crop yet. The more aggressive approach would be to simply hedge new crop by buying puts on old crop, working with the theory that since we are in an inverse, you're going to have puts on what's overvalued and what should lead us lower if we do head lower. We do like doing this rather than just making straight up new crop sales. Now, looking at March corn, we did hit my first target of 467. So if you're someone who has yet to take advantage of this rally at all, then you might want to consider doing so, even though we have not officially alerted a sell signal for old crops since 451 when we tapped the 200-day moving average. So that next sell signal is likely going to come at my next target of 485, which is 8.5 cents away. Still not a bad idea to price a small amount here and take some risk off the table, as we are 74 cents off the August lows. Many would advise you making 5 to maybe 10%, depending on how sold you already are. If you don't want to make a cash sale, you could substitute that sale and just buy a put for downside protection instead. Then once you make the sale, you just simply lift the put. That's how the basic, typical hedging one-on-one works. Keep in mind, not long ago, everyone was worried about $3 corn. I think it's likely that we're going to get a correction here shortly, as the market just doesn't go on a straight up in straight lines. But bottom line, 485 is the next target. So now here's 3 reasons why that's the target. So I explained this a little more in Friday's video, but simply, we're in this ascending triangle. We broke out of it. The conservative implied move to the upside is going to be 485. Reason number 2 is that it is 78.6% of our May highs. So 468 was the 61.8% retracements, which was why that was my previous target. We hit that. Next stop is this fib level. Then reason number 3 is that it is the 161.8% retracement from this move right here, this first move from our contract lows all the way up until 452. So basically how that works is you just take this 48 cents move, you times it by 161.8%, and that brings you to 482. Lastly, for corn, I just wanted to mention that corn did break this downtrend that we have held since October 2023. So that is a good win for the bulls and hopefully can bring some more upside. Next, taking a look at soybeans. Fundamentally, it is hard to justify beans rallying, but beans are now $1 off the holiday lows from just a few weeks ago. This happened even with the big Brazil crop starting harvest, China imports flattening, and U.S. demand in question. The report was bullish, but it doesn't change the fundamentals enough to put soybeans in bull market territory, anything like that. Not to mention the global situation still remains bearish, but we are seeing the funds covering some shorts, and we do have a technical breakout on the charts here. Soybeans broke that downward trend from May. Then they also closed above the 100-day moving average for the first time since May. So that's sparking some interest from the funds here short term. Now, the funds don't seem too concerned about Trump and tariffs. He takes office in a week, and the funds are pretty much even right now, sitting at just short 28,000 contracts. One potential risk has to be tariffs. If we get headlines about tariffs, beans are going to take it on the chin. Argentina still looks dry for another week or so, which could give this rally a little more life here and provide a weather scare opportunity, but looking more bigger picture, I don't think it's really going to make a big change on the global balance sheet, as Brazil is going to have a monster crop either way. The report was bullish, but not bullish enough for me to say we're going to go to $12. U.S. balance sheet isn't necessarily bullish, but it's not bearish enough for me to think that sub $9 beans has this super high chance of happening anymore. If you look at the chart, we did hit this short-term target I had out there if you were someone who was looking to take some risk off the table. So the next upside target is going to be right around this 1080 level, basically just this black downward trend line. So we tapped it once, tapped it twice. Now hopefully we are able to do it once again. If we crawl up there, I would definitely recommend taking risk off the table, as when Brazil's crop comes online here, it is going to add pressure. If you have to move beans within the next few months, I would reward this rally, dollar off the lows. The February puts are a pretty cheap way to protect in case Trump's just going to send this market right back down when he takes office. I am still being cautious of the seasonal in soybeans. Seasonally, we do rally into mid-January and then sell off pretty hard starting really soon. This seasonal usually coincides with the pressure the market can see from Brazil's crop, but then again, we were supposed to rally in December, and we didn't do that either. Lastly, taking a look at wheat, it was a great day today, but the wheat market was really the disappointment of the report. Pretty much nothing noteworthy to talk about. Overall, it does feel like the market just pretty much wants to short wheat as a hedge while buying the other grains, but I don't think that's going to last forever. Bottom line, not much to update here. Long term, I do still think wheat has plenty of potential for several reasons I've mentioned before. I believe we're closer to a bottom than a top, and I have zero interest in selling wheat anywhere below $6. If we look at this chart, we are potentially breaking out of this falling wedge I've been talking about for a while, and that downward trend from our May highs. So this is a bullish pattern, but I would like to see one more little leg up to confirm a breakout. And lastly, looking at KC wheat, pretty much the same thing here. We're flirting with this little breakout here, continue to hold the lows. One more leg up and this chart will look good as well. That's all I have for today. If you have any questions, give us a call or text 605-295-3100. Thanks for watching.